Good day, students. Welcome back to ACCA e-learning. Our focus today is still on cost of capital. My name is Andrew Pinnock. We're looking at a capital asset pricing model, CAPM, as well as a little bit discussion about the portfolio theory. Now let's see what CAPM means. You know, the previous session, which is session 1, we talked about calculating cost of equity. I will actually said you can calculate cost of equity using two methods. One of them is the DGM, which is the dividend growth model, and the other one we said is CAPM. If you can go back to our previous session for revision. So we've looked at DGM, now we're looking at what? CAPM. So let's get down to business. Now what is CAPM? Remember what we said in DGM? One of the disadvantages of DGM in the last session was that it fails to incorporate risk. The formula fails to incorporate risk, and that is what CAPM solved. So when using CAPM to calculate cost of capital, which is like cost of equity, which is the cost of equity in this case, you will find out that CAPM incorporates risk into the calculation of cost of equity. Now what is CAPM? So this model is used to calculate cost of equity, and it incorporates what? Risk, unlike what? DGM. The model explains that by multiplying the risk, here the risk here is systematic risk, which is denoted by the beta. You see it denoted by the beta. In this case, it's the equity beta. With the market premium, sometimes they call it risk premium, market premium, equity risk premium, which is denoted by what? E into bracket RM close bracket minus RF close bracket, and adding it to the risk-free rate, which is denoted as RF, it will give you the cost of what? Equity. Now in summary, the formula for finding cost of equity using CAPM is this: ERI, sometimes I like denoting my ERI with KE, RF beta multiplied by what's in this bracket, which we said is the risk premium, you get a cost of equity. So well, ERI is what? Cost of equity. RF is risk-free rate. ERM, which is the return from the market as a whole, yeah, will be given to you, or it may be given in the form of a premium, which is very easy to calculate. B, which is the beta, the beta factor of the share. Now let's see simple example and see if we can use the formula. The examiner, as I said before, may not tell you which of the formula to use, but when you start seeing beta, risk-free rate, risk premium, that it's an idea that he wants you to use CAPM to calculate the cost of equity. Why do we need to know all these cost of capitals? It's because at the end of the day, we use it to calculate WACC, weighted average cost of capital, which companies use to discount their investment appraisal. We need to know the sources of finance, which is in a different session. We'll now look at the different costs of this finance that we have chosen for our business. Then what is the weighted average cost of capital? And if we are trying to use it to appraise another new investment, it will be the cost of capital we use. Now let's see a simple example. It says shares in Lexor PLC has a beta of 0.6, risk-free rate RF of what? 6%, and the return from the market is what? 12%. What is the cost of equity of Lexor PLC? Now, using our formula, I said I like denoting my ERI. This ERI you see there, I like denoting it as KE, so that I just know its cost of equity. So it's more or less saying KE is equals to RF plus beta ERM minus RF close bracket. So if I put this information in the formula, it becomes, the risk-free rate here is what? The risk-free rate is 0.6, so that becomes 0.06 plus The beta here is 0.6. The return from the market is what, 12%, so I say 0.12. Take them to decimals. Risk rate is 0.06. So this will come to 0.036 plus 0.6. Oh, no, sorry. Yeah, that's it. What is in the bracket? Okay, let me do it again so that you understand properly. What you have in the bracket, this 0.12 minus 0.06 will give me, let me say 0.06 plus 0.6 into bracket 0.06 to bracket 0.06. Sorry, trying to manage the space. And this will now give me, if I multiply this by this, if I multiply this to this, will give me 0.036 plus 0.06, and this should give me, multiply by 100, should give me 9.6% as my KE. So my KE is 9.6%. 9.6%. Very easy. Just put them in the formula. It's very easy to understand. Solve it, and you're good to go. Now, the examiner may not give you the return from the market in this case, and the the return from the market in the question. He may just give you the risk premium. And that takes us to the next slide. It's saying the risk premium or market premium is the answer, is the function of what is in the bracket. So if he gives you the risk premium, that means he has given you ERM minus RF in the question. So if you're looking for the return from the market, ERM, you will not see into the question. You will just see risk premium or market premium or equity risk premium. That means he has done what is in the bracket for you. All you need to do is just to apply it to the apply it in the formula, and you get your KE. Now let's look at this simple example. You say A and A shares currently have a beta of 1.1, and the market premium is 9%. Risk-free rate is 4%. So you can see that he has given you a statement here. He means that he has given you what is in the bracket, which is 9%. So there is no need, you will not see, you can see the question, there is no return from the market. What you have is the risk premium. That means he has given you what is inside the bracket. So I guess we can solve that now. Let's see. If we say KE is equals to RF plus the beta, ERM minus what? RF. Now he has given us what is in the bracket. So that will be KE will be equals to RF. The risk-free rate here is 4%. Put it in decimal, 0.04 plus the beta here is 1.1 into bracket. Now he has given us the risk premium. Everything in the bracket has been given to us 0.09. Take it to decimal. Remember, do these two first before you add it to 0.4. Do not say 1.1 plus 0.4. The 1.1 is going with the bracket. It's the answer you add to the risk-free rate, which is this. I hope that is clear. Okay, let me erase this. So if we do this with our calculators, we should be getting, this will give us 0.099, add it to 0.04. Okay, therefore your KE will be equal to, if you add them together, express in percentage, that will be 13.9%. Very, very easy. just apply them in the formula and you get your full marks. Now let me give you a coursework. You know how we do it. You know how our style. You pause, try and solve the question, this question, solve it, attempt it, then play to see the solution. All right, I guess you did that, but let's do it together. If investors' required rate of return, there's a new statement here, required rate of return, from shares of B and B is 14.5%. The risk-free rate, which is the RF, is 7%, and the equity risk premium is 5%. Required, what is the return from the market, and what is the beta factor of the shares in BLB? Wow, now we are to answer what the beta factor, we are going to look for the beta now. We are going to look for the beta in the formula. But where is the cost of equity? Because if you're telling me the KE is RF plus the beta, close bracket, ERM minus RF. The question is, where is this? Because this is what we're looking for now. I have the premium, which is this 2. They say the premium is what? 5%. The question is, where is this 2? Now, the language the examiner used here is to say the required rate of return. It can be assumed that is the cost of equity. If shareholders are requiring 10% from an investment, that becomes the cost of equity. So the required rate of return here will replace KE. So that means I have KE now to be what? 14.5%. But of course, I still have this to look for, which is the second part of the question. Now, let's answer the first part of the question before we go to the second part. See, what is the required rate of return from the market? The required rate of return from the market, I know if I have the premium, if I have the risk-free rate, I think I can find the required rate of return from the market. Yes, I think so. I have the premium. The premium is 5%. Have the premium as 5%. And have the risk-free rate as what? I have the risk-free rate as 7%. And I know that the return from the market, let me denote this as X, minus the risk-free rate, minus the risk-free rate will give me the premium. Therefore, the return from the market, which is X, should be 7% plus 5%. Therefore, X is equals to what? 12%. Easy. If I know what the premium is, I think I can calculate what the return from the market is if you give me the risk-free rate. If you are given the risk-free rate, the question. Now let's do the B part. What's the B part? The B part is say, what is the beta factor of the shares of BLP? We've already agreed that the return from the market, which is KE, is 14.5%. So let's rewrite the formula out. It becomes 14.5% is equals to 7% plus, let me denote it as X, is equals to 5%. Yeah. I don't know what X is, which is the beta. That's what I'm looking for. This becomes what? This becomes 0.145. Put them in decimals. 0.07 plus X to bracket 0.05. Okay. Now, if we remove the bracket sign, it becomes 0.145 equals to 0.07 plus 0.05x. Therefore, what you now say is 0.05x is equal to 0.145 minus 0.07. Move all like terms together and the rest of them. Once you move to the other side, it becomes minus. This will become 0.05x is equal to 0.075. Just cross check your calculator, make sure it's correct. I know it's correct. I hope it's correct. I know it's correct. I know it's correct. All right, let's move on. Let's see. Therefore, x, make x the subject of the formula. It becomes 0.075 over 0.05. Therefore, x, which is equals to what? 1.5. So it means that the beta is 1.5. So let's say this is the B and this is the A part. Sorry. Okay. This is the A part of the question. And that is the B part of the question. This is the B part of the question. Very easy to solve. Now let's look at another question. I'm getting excited already. This is one of the ACCA CB specimen questions on the website. Past questions, March, June, I think 2019. Okay, one of the easy questions there on the platform. You can go to the ACCA website and check for it. Now, if you see the question here, easy 2 marks. I guess students should not spend more than a minute in solving this. Let's see. It said Tulip Co. is a large company with an equity beta of this. This is the beta. Remember, it's the equity beta. We said it's the equity beta. That's what we said here. Equity beta. Let's go back to the question. So the company plans to expand in existing business by acquiring a new factory at a cost of $220 million. The finance for the expansion will be raised from an issue of 3% loan notes issued at a nominal value of $100 per loan note. The loan note will be redeemed after 5 years at a nominal value or convertible at any time into ordinary shares in Tulip Co., with the value expected to be $115 per loan note. The risk-free rate of return is 2.5% and the equity risk premium is 7%. Tulip Co. is seeking additional finances, considering using Islamic finance, and in particular would require a form in which is similar to equity financing. Now, well, let's look at the requirement to see what is the cost of equity using the cap M. Wow, so easy. Let me write out the formula first. So, so beta, which is ERM minus RF. Okay, let's start bringing up our variables. RF, risk-free rate in the question is 2.5. Sorry, oops. Okay, that's 2.5%. What else again? We have a risk premium. Whoops. That's the bracket itself. The whole of this bracket is a premium. The whole of this bracket is a risk premium. So risk premium, let me just call it risk P, is what? 7.8%. You give me beta, the equity beta, which is the beta here. The beta is 1.05. So with this, I think I can slot it into the formula and get my answer very, very, very quick. So that will be KE, this will be 2.5% plus 1.05. The premium is 7.8%. If we bring this to decimals, this will be KE 0.025 plus 1.05 sorry, I'm putting them in decimals now, so so that will be 0.078. I think we can do that very fast now. Let me just demarcate here. Okay, so KE therefore will be equal to 10.69%. Okay, let's look at the objective. Okay, we have 10.7, so that is approximately, okay, so that will be KE is equals to 10.7%. So I just go there and click this answer. Well, easy 2 marks. Very easy to solve. Once you look at the information, it guides you whether you're using DGM or CAPM to calculate cost of equity. Once you start seeing growth in dividend, you are seeing dividend payments and the market value of the share ex-div. Aha! You are asking me to use DGM to calculate KE. Once you start seeing equity risk premium or return from the market, risk-free rate, beta, you're asking me to use CAPM to calculate cost of equity. So the examiner may not tell you which of the methods or models to use. Now let's look at the portfolio theory. Portfolio theory. Now for the portfolio theory, what is the portfolio theory? Now what this theory is saying that the theory suggests that investors can reduce their total risk on their investments. By having a diversified portfolio. So it means that if you have different shares in different company, if one share price for a company A does not do well, it will compensate another share price in another company that does well will compensate for the loss you make that the other company shares are making because they are not doing well. So you don't have shares in one company. You have shares in different companies. So if this company is not doing well, for example, you have shares in the banking sector, you have shares in the manufacturing sector. If the banking sector doesn't do well and the manufacturing sector does well, it compensates for the loss that comes from the banking sector shares for not doing well. So total risk can be reduced by having diversified portfolio. And of course, what is the make of this total risk? What is this total risk? The total risk is made up of 2 types of risk. Total risk is made up of 2 types of risk. Let me bring this one down. Systematic risk and what? Unsystematic risk. The idea is that unsystematic risk can be diversified away. Because the unsystematic risk is specific to the company itself. So it can be diversified away. But systematic risk cannot be diversified away. It's a function of the market activity itself. It is caused by different factors, and it cannot be diversified away by the shareholder by having diverse portfolio. But unsystematic can be diversified away by having diverse portfolio. And again, the beta you see in the CAPM formula is a measure of the systematic risk that is attached to that particular security or shares. So the beta factor in the CAPM measures the systematic risk that is attached to a particular share. Because the assumption is that unsystematic risk can be diversified away by having different portfolio of investments. So the beta you see here, the CAPM, is a measurement of a risk attached to the share price. And this risk is what? The systematic risk. And that is what the DGM failed to incorporate in their what? In their formula. The next session we'll be having after this session, we'll be looking at gearing and ungearing of betas or geared betas, where we may need to solve for this first before we use the CAPM formula in calculating the cost of equity. Thank you very much. My name is still Andrew Pinnock. Thank you very much for listening to this session. Thank you.